Crash or correction? Is the Royal Commission going on far too long? And will Bill Shorten's dividend imputation change of policy affect a whole lot of other things, including hybrids? I'm Peter Switzer.
I'm Paul Rickard.
And we're mad about money. Paul, I was asked on Sky News on Friday, is the worst of this over? And I jumped in and said, yes, I think it is. And bang, we lose 600 points on the Dow yesterday. Is this going to be a correction or a crash?
Well, a bit of a surprising performance on Monday night, down 100 last night. And look, I guess given the Monday night performance came on Veterans Day, a lot of the US fund managers are away, the bond market's closed, it was a big move down. Yeah. I guess what we're seeing is the technicals, there's nervousness in the US still, and until the trade situation is everyone understands exactly what President Trump is going to do, the market there's going to stay a little bit on edge. I mean, I was with you, Peter, thinking it's a correction. I still think it's a correction, but I'm probably not as confident today as I was
It's
last
a scarier correction today than it was last week. Paul, interestingly, I think Bank of America does a survey of US fund managers, and 35% of their fear is all around the China trade deal. So people try to say, it's not very important. Well, the fund managers, they're scared about it. And Larry Kudlow, the economic advisor to the president, came out and said, we are talking to China, and the market instantly went up. So that's one important leverage point that this market needs to deal with. And if it does, I think this will end up being nothing more than a correction. But there are some scary signs
there.
There are
some scary things. And to be honest, our market's done pretty well. It did well on Monday. We had an update on Monday following the leader from Wall Street on the weekend. Yeah. So our market's actually shown a bit of strength, mainly in the banks. We've talked about that for some time. I mean, we've got a very different structural market. I mean, I look at it last night, I'm probably more worried about the oil price. Yeah. And what that actually means about real underlying demand in terms of growth. The oil price has come down so quickly.
Why?
Well, I guess it's all about supply. That's
too
the
much
alleged
supply.
Reason. I don't try to understand the oil price market, Peter.
Very true.
The equities is hard enough. But for what I read, it's all about supply. And of course, the Iranian sanctions haven't quite been the sort of the death knell to the market that people expected, and of course the Saudis and others and the Russians have boosted supply. But the oil price, US oil price, it almost got to $80. It's down to $54. That's a huge fall in about 8 weeks. It's going to be bearish for our market today a little bit. I mean, the BHPs, the Woodsides, the Santos, they're going to be impacted. I'm sort of more worried about, is there an undertone about, does that actually mean that demand is, in terms of growth starting to slow? So I think some of these buyback opportunities might be a chance to sort of lighten off in some of the resource stocks. So that's where I'm sort of looking to make a slight lightening in this market.
Okay, and quickly, Royal Commission. My worry about the Royal Commission is just going on too long. And what I'm finding out is a lot of people who would have got a loan 6 months ago now can't get a loan because banks are just scared of the Royal Commission and they're just being really tough on all borrowers. That's scary for the economy, Paul.
Scary for the economy, and as per the government's announcement this morning, your $2 billion help with small businesses. But the Royal Commission is scary for the economy. I think we've still got all the ASIC and APRA bosses and the major bank CEOs to appear in the next few weeks. Yeah. It does need to wind up sooner because, and Labor's still got a policy to extend the crazy, thing. So look, it does need to come to a head, and let's get on with life.
Yeah.
But, we don't want it to go too far because it could be a little damper on the economy.
Look, simply, the people who've been badly treated deserve compensation. Get that happening. Put a new tribunal system in place, which they've got called AFCA, which they're not even telling people about, the Australian Financial Complaints Authority. And that means people can turn up and take a bank to the AFCA and no lawyers, get it settled, and usually AFCA will support the consumer. So get it over and done with and start giving people money who deserve money to go out and buy homes or develop their businesses or whatever. Now finally, Paul, dividend imputation, the changes that Bill Shorten's proposing, and its wider effects on, we thought it was going to be retirees purely not getting a tax refund, but you say it's going to be wider.
Well, of course it is just about the tax refund, but look, I mean, obviously people have been focused on a lot of the bank's shares and Telstra, but there's other parts of the market that are going to be just as impacted, if not more impacted. So one of those is the hybrid securities markets, and that of course is, these effectively capital instruments from the banks. They pay a fully franked dividend, not a particularly attractive cash dividend, but the benefit is the franking.
And a retiree who buys that.
A retiree buying into their self-managed super fund, take away the refundability of the franking credits, and the return's down to about 4%. Not particularly attractive for the risk.
But it will be grandfather, the people who are already in. Right?
Well, no grandfathering on that, because there's grandfathering on negative gearing, Pete, but not and CGT discounts, but not grandfathering in terms of imputation. It all stops come the 1st of July 2019. So just a bit of a caution, CBA had an issue, Pearls 11 last week, paying 3.7%. I wrote, is it not a pearl? Oh, that was. Is it a
pearler?
I think that was a very helpful sub-editor, and I don't think it's a super rate. Westpac's also this week on Monday announced an issue at the same sort of margin, 3.7 to 3.9%. This is mid-range stuff, but I reckon there's a bit of risk here. So I think I would be, given the attractiveness of bank ordinary shares, I don't think the hybrid market is a particularly attractive place at the moment. I caution about not a lot of talk about what's going to happen on dividend imputation and the impact on that market. These are going to be even more impacted, I think.
Yeah, but also, Paul,
it's largely bought by retail investors.
I also noticed today that retail super funds are going to be affected by the dividend imputations, and so retirees who are in those sort of funds could actually get less refund as a consequence of the changes and the impact on those super funds. So it's a really, really difficult piece of policy.
This change is a big change. It's a huge change for the markets. It's a huge change for lots of people that have built up their superannuation. You need to get on. You've got to get out to the politicians. You've got to tell your kids. You've got to sign up for all the petitions out there.
Don't do it, Bill!
Don't do it, Bill. The policy has to be changed. So if you're watching today, get on your, well, I won't say get on your bike, but
get on your computer.
Get on your computer. You need to work hard on this because, like all things, politicians ultimately are sensitive to what voters are saying, and they haven't thought this change through properly.
Exactly. I'm Peter Switzer.
I'm Paul Rickard.
And we're mad about money.
Content has been prepared without taking account of an individual's financial objectives, needs, or financial situation. It does not constitute formal advice. Before acting, any individual should consider the appropriateness of the information, having regard to the individual's financial situation, needs, and financial objectives. Past performance is not a guide for future performance. AFSL 286531.